Welcome to the Smart Property Investment Show, the podcast by investors for investors.
G'day, how you going? It's Phil Tarrant here. I'm the host of the Smart Property Investment Show. Hope you're well. Joining me in the studio for a very special edition. We're going to go hard, we're going to go tight, we're going to go fast. So hold on, strap in. The one and only Arjun Paliwal, who for many years has been running one of Australia's top buyers agencies. Arjun, how you going?
Good, my friend.
You, mate.
Yeah, good to be back.
Well, I just heard that you just spent an hour or so on a live stream webcast talking about first-time investing next door in the studios. How did all of that go, mate? Is it good?
Mate, it was good. I think the best thing is we could tackle it from all fronts, accounting, property and finance. So having multiple experts come together. Everyone talks about building a team. That's a team right there where we could all talk about it together.
So you should, as a property investor, have a good relationship with your accountant, broker, buyer's agent, but importantly, they all need to be able to connect and communicate together.
Yeah, when we were talking about that, one thing I left with the team was to say, hey, when you're building a team, don't build a team that just focuses on their KPIs, focus on your goal as a client, right? Because when you're focusing on KPI, the accountant wants to save tax, the broker wants to save interest, and the buyer wants to just get growth today. And these three KPIs, if they each just isolate to themselves, they can head you in different directions. You get stuck.
Yeah. So I encourage everyone to go and tune into that. It's around first-time investing. Now, today's conversation, I'm going to assume a fair amount of knowledge as we go through some pretty sophisticated concepts in and around property investment. But on the Smart Property Investment Show, we cover everything from, new to market, I've just found property investing, I want to learn about it, versus strategies and tactics for people who have been in and around property investment for some time and or have quite a large portfolio. So today there's going to be some assumed knowledge, but go and tune in to the special webcast. You'll find it on smartpropertyinvestment.com.au, where you'll hear all the pieces of brilliance there from Arjun. Now, Arjun, I want to break down, I've got about 20 minutes today, I want to break down the market cycles and which areas of Australia fit within them. And this is a construct that I know you deploy in your business, InvestorKit. And Arjun has run InvestorKit from its inception back from 2018.
Yeah, 7 years now.
Is that 7 years?
Yeah, time's flying.
God, 7 years. And well regarded. You've probably seen Arjun across a lot of his social channels, but he's also quite an in-demand media commentator. So it's good to get him in the studio. But the construct is, and this is a framework to help you look and assess different markets. And InvestorKit is well known for being very much a research-driven, research-led decision-making buyer's agency. You've got the early adopter market, the hotspot markets, and the second wind market. So I quite like this from a conceptual point of view.
Yeah.
Is this your sort of approach, or did you come up with this sort of scaffold to assess?
Yeah, the cycle analysis framework came out of two things. Firstly, understanding what works, why it works that way, and what patterns have come from analyzing decades of research. And the second thing is it came from frustration with the property clock. Everyone talks the property clock, and then all of a sudden I'm there, popcorn's out, you're like, oh, area's at 12, won't be long until it's at 2 or 3. Then it jumps back at 9. You're like, what the hell is happening here?
I never really understood the property clock, and people sort of used it as a construct. And I sort of went, was it 6 o'clock? What does that mean? It's like swinging from a buyer's to a seller's market?
I know, right? So 12, all of a sudden you think you're going to get into a dip and you can buy just as it recovers. And then you look at it, it's at 6 and you're like, wow, this is the bottom. It's time for me to get in. So when it gets to 9, it's going to start rising. 6 goes back to 4. Or 6 goes up to 11, and you're like, how the hell is this moving? Who's making this happen? And unfortunately, just because it's so simplistic, everyone loves simplistic things, and therefore they give it a lot more merit than it deserves. So out of frustration for the property clock, and then out of studying all the data and trends over many decades, using AI, using the human touch, combining it together with a research team that spends upwards of $500,000 on analytics itself, that to us was the key for us to go, this is the 3 that really make sense.
Okay, makes sense. Now, before we get into the nitty-gritty of it, just give me top line. We're in between the first interest rate cut. We've got another interest rate decision happening in about 2 weeks' time. Who knows what will happen? We also have a federal election which will be called soon or thereabouts when that takes place, in the federal election in May. So first interest rate cut, what are you seeing in the market right now before we get into some of the structural stuff?
Yeah, absolutely. So firstly, what I'm seeing is sentiment is ramping up. And sentiment, if just to simplify what that will be for everyone, how people are feeling, right? And how people are feeling right now, because of our scale, we can judge it by our website form. If our website form is popping off but advertising is remaining consistent, there's anomalies to do with ourselves. It's to do with external factors. And it's been really firing away. So it's clear that people are thinking has turned into translation of I better get doing. So I think that's the first part, is a clear sentiment shift in Australia. And the funniest thing I'm learning, though, is that a lot of these people had the capability to do it 3 or 6 months ago. So don't be one of those people going crazy just because, but actually start assessing where you're at, only because if you think that you can make a move and you're in a healthy position to do it, that always the best time is yesterday or today, not tomorrow.
So you haven't missed it?
Haven't missed it, because I think the actual sentiment translating into, something happening in the market hasn't quite flown everywhere just yet. And that's the beauty of property. Like, there are markets within markets. You can look across the country and see what's right for your portfolio, but also what's actually happening in certain cities isn't happening everywhere. But the main thing to point out is there is a sentiment shift. A lot of people are thinking, asking, inquiring, and that's why I referred to the website hits as one part. But the main thing to recognize is I'm just surprised by so many people thinking of doing it now who had the capability to do it 6 months ago, 9 months ago, 12 months ago. Don't be that person where you react off that federal election or the interest rate as your decision to go or hold back.
Yeah, and there's a really good way for us to frame this discussion today, because, I asked you a very colloquial question: have you missed it? Well, you've never missed it in property. If what happens, that missing it is an individualized thing rather than a market thing. So you might have missed your ability to get into the market sooner, and therefore you've missed the opportunity for capital growth. If you're ready to buy, there's always a market you can and should be buying in, because it's going to show you the best thing. And that gives you an idea of this constructive early adopter markets, hotspot markets, and second wind markets. And when you actually deploy your dough into these different markets, it's going to be, again, an individualized thing, because where are you in your own property investing journey? How much capital do you have? How big is your portfolio now? What's your cash flow position? So that's all connected with it. But let's talk about early adopter markets straight off the bat. And I got some examples. I'm thinking out loud where they would be, and I know you're going to give me some examples. But give me a frame of reference of the early adopter market, Arjun.
Yeah, absolutely. So the early adopter market was basically going into a cycle before it grows. And the key thing with the early adopter market, and this is the beauty about all three of these cycles, is that you're in an information and technology world today. You're in a world where you have the choices and the decisions. Whereas before it used to be, this person seems knowledgeable, they seem experienced, they've done well themselves, their property's a good asset, I hope it works out. Right? Whereas now, as we're in an information world, we can combine the strengths of the past and go today and go, well, these cities are here, these cities are here, and those cities are there. What fits to you personally? Budget, life stage, goals, risk appetite, and that's when you tailor these cycles to you. Now, take all that tailoring and approach of the cycles, bring it back to early adopter. Early adopters, in the most simplistic form, are markets that haven't done too much in the past, are seeing new signals today that represent a change, because you can't just rely on hasn't done too much, because 3 years of haven't done too much can turn to 6, 6 can turn to 9, 9 can turn to 12, 12 plus 15 even years. But the main thing is that something's shifting. And so when you're seeing that something shift, we usually look at a few data trends. Are houses for sale against 5-year averages, how that's trending? Rental market trends, how that's changing? Price growth on shorter intervals, 1 month, 3 month, 6 month, 9 month, 12 month, against 1 year, 3 year, 5 year, 12 year, 10-year averages. So you're really looking at micro movements, because if something's just keeping on what it's keeping on, then really it's not a change. You can't adapt it into that cycle phase. But then also we're starting to see a lot of economic drivers, starting to see construction weakness. Now you might think, well, construction weakness, isn't that a bad thing? Well, if you have many, many years of it off the back of a boom cycle in the past because they hit the mark and overshot, then all of a sudden you have supply dwindling in an area, both from new builds, existing builds, and rental markets. So early adopters then have that pro of going, well, you're in a cycle earlier, but the con is got to be a little bit patient though, because you could get into, for example, let's talk a city, right? Brisbane in 2018, early adopter. Someone may have thought it was a perfect early cycle in 2014, then 2016, and then 2017, and really 2018-19 was the right time to get in.
Yeah.
Right. And so I think the key is getting all these data points right, recognizing that cycle, that something's shifting, and then attacking it where you have the pro of great negotiation, great choice of stock. You're not jumping in when the party started. It's usually before the party started. But the con is you've got to be a little bit patient because it doesn't always ramp up.
And I completely agree. I got in the Brisbane 2015, I would say, and went pretty hard in Brizzy, thinking we're going to get the same experience we had in the western suburbs of Sydney in 2012, 2013. It didn't happen. We waited probably 3 years longer than what we thought for it to spark. But when it sparked, and it's continued to grow and deliver. So we were able to hold those properties during that period of time. Despite the fact that, we probably could have deployed our money somewhere else at that point in time and got a better immediate kick, but we wouldn't have had the long-term kick that Brisbane has delivered. I would also say an early adopter market would have been Perth back in 2000, maybe 2001. I remember at the start of COVID having discussions with people, and only then there was grass shoots indicating that Perth was the place to be. That would have been early, maybe 2019 even.
Yeah, so that's a good point. So if you go to the past, and then we'll also bring it back to the current, if you go to the past, you see Adelaide, Perth, Brisbane, and Adelaide, Brisbane would have been 18.
Yep.
Going into Perth, you're talking 2020. And if you're talking the regional markets, 2020, 21, you've got Townsville, you've got Bundaberg around 2020, Toowoomba in 2020. So you've got a few of these pockets that kickstarted then. If you're going to regional Victoria, 2017.
Yep.
If you're going to Hobart and regional Tassie, 2016 and 17. So I think in a perfect world, taking this information and statistics and going back to when you started in 2015 with that Brisbane example, I would have said, well, let's tackle Tasmania in 2015 and 16.
Yeah.
Then let's move the money to Brisbane and Adelaide in 18. And then, regional.
And in hindsight, I could have done that. Would have had different assets, but I'm pretty happy with the outcome. It's pretty good. And Brisbane still delivers. So what's our early adopter market today in 2025?
Yeah, sure. So an early adopter market today in 2025 is definitely showing in Melbourne's more affordable rings and even to the premium markets in Melbourne. But Melbourne overall is definitely one. Some signals are also starting to show in Darwin, which is interesting. And I think these two markets, again, if we go back to them, we've had lack of performance. We've had a structural shift in the sentiment and some of the economy there today. And Darwin's an example of many new projects in the pipeline. But Melbourne is definitely one as well when it comes to its long-term price trends versus today. But the main thing is you don't just rely on something going, hey, it's not been growing well for some time, therefore Melbourne's a great market. Just like in 2015, we're talking Brisbane. You got to see things changing. And so we're starting to see many suburbs show sales volume increasing. We're starting to see vacancy rates reduce, days on market reduce. So in summary, people are buying faster, buying more of it, renting things quicker, having less discounts when they're buying, having more jobs in certain pockets created, and then all of a sudden you put it all together and it's like, hey, something different is brewing now than it was some years ago.
Okay, some good indicators there. So let's talk hotspot markets, but we'll go to a break beforehand. Stay with us, back in a moment. Now, Arjun, early adopter markets, I like the idea and how you've constructed that. Talk to me about hotspot markets, which most property investors, if they're new to property investment, all they hear about is hotspots.
Yeah, absolutely. So hotspots are the most confident-driven decisions when it comes to data, because in hotspots, you're relying on the fact that something is already happening because the name itself says it. It is a hotspot. Now, hotspots are usually areas where they're outperforming their long-term averages. They're extremely undersupplied for sale, extremely undersupplied for rent. Their economy is strong or stable. And they're also seeing a lot of demand in terms of speed of selling, number of transactions occurring. So you're quite steaming at this point, right? Now here with hotspots, property is what we call a slow-moving asset type. People think that, oh, you've missed it, like you come back to before, if the market's booming, it's too late now. Well, the market just doesn't stop or start overnight, right? Their data is typically 1 to 3 months in delay. We're waiting for transactional shifts. If you have 50 people in an open home, 49 people don't buy that house, one person does. And so now 49 people are now considering what goes on the next weekend. And very rarely does someone get a pre-approval 3 or 6 months lasting, go in one, miss it and go, oh, I'll call that a search. We'll call it done. We don't need to do anything. So I think the key here is to recognize is that once you have high confidence in data, it is growing. The upside is when you get in and you eventually become that 1 out of the 50 that nails it, the competition will create movement. And this is the biggest part that people make a mistake. Growth does not exist without competition, right? So meaning you actually have to see high stakes movements, speed, missing out a few before you get one. You thought your price range was here, the house went here. Like all these things are important because if they're not happening, it isn't a hotspot. No matter what someone says, infrastructure's coming up, all of this could happen. That may be an early adopter, A hotspot is when you actually see pressure and feel the heat then, right? And so in the past, now you move those same Brisbane and Adelaide and Perth examples, now you move them to 21 and 22. Rapidly undersupplied and high rates of growth, and we're seeing a lot of activity. In the past, if you take, say, Sydney, we're in 2012 to 2016 territory.
Yep.
If you take regional Queensland, Townsville, Rockhampton, we started it in about 22, right? 21 for Rockhampton, 22 for Townsville. So the main thing here is that you're seeing a lot of heat and you're likely to get capital growth almost immediately. You're likely to get large amounts of it, but the downside is high competition, high stress, low options, fast speed. Now, that's the key things. The final mistake I'll say in the hotspot that people make, though, is that they think an area is done when it's not really done. It's probably just getting started. The most common thing people had, and I'll give Hobart as an example, 2016 to 2018, Hobart boomed, and then many people saw the rest of Hobart and versus the rest of country, said, hold on a minute, Sydney's declining, Melbourne's declining, Brisbane's flat, just starting, Adelaide's flat for 7 years. That's it for Hobart. Must be done now. Nowhere else is doing it. Why is that city special? Well, 2016 to 18 went on to about 2021, 22 before Hobart slowed a bit. So the key is cycles can keep running if the same conditions exist. And this is why Adelaide has surprised many. Kicked off in 2019, me and you having a laugh about it. You were like, Arj, are you sure, mate? It's a sleepy city? It's like, hey, it's I know, right? It's got that label. But the data hasn't come off. And every year we looked at it, it's like undersupplied, under-rented.
So is that still a hotspot?
Well, it's still growing.
Yeah.
It's still a hotspot. So where the hotspot falls off is where complete trends have completely fallen off. And so for as long as it's undersupplied the way it is, it's going to grow above long-term averages. But if we're now going to other hotspots that are truly hotspots, and there's no question about it, I'd say markets like Bunbury and Geraldton in WA.
Yep.
I'd go to Queensland and say that there's Rockhampton, Townsville as some examples, even Gladstone. And then if you're looking at South Australia, you've got Barossa Valley and parts of Adelaide still moving quite strong. So there's a fair few hotspots still across Australia.
Do you like investing in hotspots?
Yeah, I do, because I've seen the fastest rates of capital growth there.
Okay.
Even if I had two friends together and one person got in early and one person got in when it's hot, if the person's goal is to acquire a subsequent investment sooner because their savings capacity isn't there, hotspots allow that to occur.
Okay. So for a
That's
point in
key.
time, it's the right optionality for certain people to
Yeah.
do that. And again, it comes back to you as an individual. But often, to your point, some of these have second wins, and this is the sort of third construct. Second win markets. So we spoke about hotspots beforehand. I'd say Perth's probably starting to wane as a hotspot. I think there's probably better places to deploy your dough today than maybe Perth, or you might have missed it. However, is it going to have a second win? Tell me about second win markets.
Yeah, so Perth, I'll use that example and then we'll talk second win. So firstly, from Perth, the outer ring is showing some slowdowns in the trends. But funnily enough, Perth's inner ring is increasing.
Okay.
So if you were to look at the Perth at a micro level, I'd say the 800 price and above is moving strong and fast. But the 600 to 800 price points in recent times, in many suburbs, not all, isn't moving the same way as it was. And so that's how you can get more micro in a city and realize that that trend's probably going to happen more nationally too, where the upper quartile of prices, interest rates continue to fizzle down. And as long as that lower quartile has picked up the way it has, you might see some separation, and the more 800 plus markets across Australia will start to do better over the years ahead, right? Now, that's the first part on Perth. But coming to second wind, you have two distinct phases in second wind. I call it second wind phase one, where a market's declining and or flat for some time, but you expect it to be a good buying window before its next rush. Second wind phase number two is it's come back again. And we might use that Brisbane topic again. In 2022/3, there was a time in Brisbane, if you look at listings data, where they surged a fair bit just for a short few months. This was just after interest rates were increasing. That first came out of nowhere, interest rates increased. And then all of a sudden, the sentiment kicked back in and supply rocketed back down again. And so overall, Brisbane had about a 6-month period of little to no capital growth that people don't remember,
Yep.
right? And so that period is described as a second wind phase one, meaning the fundamentals are strong. It's still undersupplied overall. It's still got affordability. But for some reason, the market's taken a breather or a pause. And then you go, well, if I truly believe the fundamentals are still there, why wouldn't it return back to its trajectory? So you're buying without as much competition.
I would say, thinking out loud, that probably aligned with the timing when the Queensland Premier was trying to tax property investors of their whole of Australian property portfolio rather than just what they owned in Brisbane as well. Maybe connected, maybe disconnected.
Yeah, look, I think.
But I know a lot of investors left Brizzy because of that.
Yeah.
That rhetoric. But anyway, so that's second wind phase 1.
Yes.
What's second wind phase 2?
Phase 2 is Brisbane's return to its strength, right? And to give you some other markets across the country is if you take Sydney, in about 19, phase 1 was in play.
Yep.
Because you've had a big boom from 2012 to 2017. You've had the market come off a heat for about 2 years. Negative gearing scares, oversupply in construction, lending changes and interest-only rules. A lot of things come into play, and then all of a sudden the fundamentals weakened of that city.
I bought in Sydney in 19.
There you go.
Good.
So that's a good second win phase
it's
1.
done well.
Because just if you looked at the stats from 2017 to 2025, poor performance in Sydney. But then there's moments in time where you can win against a poor trend just by having that purchase. In 2019, second win phase 1. And guess what? Popped up in the 2 years more than some cities have about 5 or 6 years. And so other examples can be Central Coast. Central Coast in the last 12 months was phase 1. Okay. Now it's moving to phase 2, where Central Coast and Newcastle are recovering again pretty quickly.
We're getting a second win in Central Coast, though.
Yeah, we are. So Central Coast and Newcastle are starting to pick up again. Other cities are Mildura. Mildura went through a little bit of a slowdown, 22 to 23 and 24. And then all of a sudden, Mildura now is starting to see a pickup. Same thing can be said with Dubbo. And now if we look at places like Bendigo, Albury, Wodonga, they're starting in second win phase 1 now, where they're representing a pretty good buying opportunity. A heat's come off them a little bit, but they may start to recover again.
So a lot of these examples you're using tells me that you just don't contain your buying into capital city markets. You irrespective of whether it's regional or metro, you'll look at all markets without any bias or agenda.
No bias, no agenda, because the fun fact is over 25 years, 85% of council regions have achieved more than 5% compounding growth. And if you remove mining reliant areas, that number creeps up to 94%. Meaning that a lot of Australia does well the long term. You pointed out to a few markets that did really well in 2000 and 2005. Right, Perth was one of them, Brisbane and Adelaide, another one. So I think if you're looking at that long-term markets of Australia, a lot of cities do well. People get surprised when they look at Darwin's 25-year average, and it's almost there in Sydney, like 5.2%. But it's our short-term memory of going, my data availability is 10 years, Darwin's horrible. But if you take it further, they do well. So if you're here looking at that as an investor, you need to firstly look at these 3 cycles and go, well, firstly, we're in an information, AI, machine learning era, experts that are able to put the pieces of the puzzle together. I have foresight and visibility. Now you have that, then you bring tailoring into the mix. My portfolio. Oh, well, I have a bunch of Queensland assets, Arjun, so maybe I don't go to hotspot because it seems like a lot of Queensland regional markets are heavy in the hotspot. So should I consider some more hedging in Victoria, or should I consider some of the regional New South Wales? And so I think the perfect investor today is someone who's borderless, someone who's data-driven, backed by a team, and tailors to a portfolio that travels long-term, reverse engineer to today. These 4 points today represent the most successful investor. Now, obviously, I'll throw in a bonus point. Being on the same page as a relationship as a couple is probably the 5th and final part. But you put these 5 points together, you're an unstoppable investor in 2025.
Well, you heard it here first. And Arjun, thanks for the insights. I know we've moved really quickly through those 3 ways in which you can view a market and probably some pretty sophisticated concepts there. So we'll get Arjun back in. We can go even deeper on that sort of stuff. But I like these sort of conversations. And I think for anyone who is starting out, or even if you've been investing for quite some time, it's a pretty good way to look at these markets. And I know you do a lot of research yourself. You make a lot of research available around this. How do people track that down?
Jump on InvestorKit.com.au.
Is it free? You
totally free.
Okay.
We release monthly research papers that are the most in-depth in Australia. And we also have our blog posts, our YouTube videos. So there's about a few hundred different types of articles.
There's an MBA locked up inside your InvestorKit around property. But go check investorkit.com.au. There you go. So it is a kit for investors.
That's exactly it, right?
It's Arjun Paliwal, founder of InvestorKit. Thanks for coming in, Matt. I know you're running out. He's off to look at some locations. I'm told he's got to jump on a plane. He won't tell us where, but I'll see if I can find out for you all, and I'll tell you. But remember to go and check out investorkit.com.au. Remember smartpropertyinvestment.com.au. Social media, smart property. Please keep those those reviews coming wherever you're tuning into this. Arjun's going to get all of his team to do it because they think the Smart Pro Investment Show is a great thing, whether they're looking on Spotify or on Apple. We'll see you again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.